Hello and welcome to the BizPage channel. In this video, we will be looking at what the Forex market is and how it works. Now without further ado, let's dive in. Forex is the links of different currencies and exchange. Currency exchange is the procedure of changing one currency into another for a number of different reasons. These reasons can include trading for commerce, which is buying products that are cheaper under another currency, trading which includes buying and selling currency for an overall profit, or tourism if you are traveling to another country with different currency. According to a recent report from the Bank for International Settlements, it is said that more than $5.1 trillion is traded daily within the Forex market. The unique aspect of this international market is that there is no central marketplace or HQ for making the exchanges. The trading of currency is conducted electronically over the counter, otherwise known as OTC, meaning that all transactions occur via computer networks between traders around the world. The Forex market is open 24 hours a day, 5.5 days a week. Currencies are traded around the world in the major financial cities. These cities include London, New York, Zurich and Sydney, just to name a few. Trading also takes place across almost every time zone. This means that the Forex market can be extremely active any time of the day, with price quotes changing constantly. Let's now look at a brief history of the Forex market. Unlike the stock market, which we are able to trace back history, the Forex market that we know of today is considered to be a truly new market in recent times. Forex has existed since different nations have begun minting and producing their own currencies. The modern Forex markets are considered a new creation. After the agreement at Bretton Woods in 1971, more major currencies were allowed to float freely against one another. The prices and values of individual currencies vary, which has provided the need for exchange services and trading. Commercial and investment banks conduct most of the trading in the Forex markets on behalf of their clients. There are also speculative opportunities for trading one currency against another for professional and individual investors. These individual investors can long-term traders, or short-term day traders. Are you finding this video informative? If you are, then do not hesitate to like this video and subscribe for more informative content. Let's now take a look at the basics of trading within the Forex market. The first thing to know is that trading is not an overnight success. It takes time to perfect the acquired skills. The investment markets can quickly take the money of investors who believe that trading is easy. Trading within the Forex market is considered to be exceedingly difficult, if you do not know what you are doing. Despite these downsides to trading, success within the market is indeed possible. It first comes with education, trying and testing different strategies. Let's recap, what is the currency market? The currency market, known as Forex (FX), is the largest investment market in the world and continues to grow annually. Looking back at some past numbers, on April 2010, the Forex market reached $4 trillion in daily average turnover, an increase of 20% since 2007. When compared to the stock exchange, there is only $25 billion worth of volume that is traded daily. The market may be large, but until recently the volume came from professional traders, but as currency trading platforms have improved, more retail traders have found Forex to be suitable for their investment goals. How does the trading work? The trading of currency is a 24-hour working market that is only unavailable from Friday evening to Sunday evening, but the 24-hour trading sessions are misleading. There are 3 trading sessions that take place in different time zones around the world. Although there is some overlap in the sessions, the main currencies in each market are traded mostly during those market hours. This results in certain currency pairs having more volume during certain sessions. Any trader who stays with pairs based on the dollar will find the most volume in the US trading session. Let's now look at some words used in Forex. Currency is traded in different lot sizes. A lot is the number of currency units that you buy and sell. For example, 1 microlot is 1,000 units of a currency. If your account is funded in US dollars, then 1 microlot represents $1,000 of your base currency. One up from the micro lot is the mini lot. A mini lot is 10,000 units of your base currency. One up from the mini lot is the standard lot, which is 100,000 units of your base currency. The next word in Forex is the use of pairs. All currency trading is done in pairs. In the stock market, you can buy or sell a single stock. However, in the Forex market, you have to buy one currency and sell another currency. Along with this, nearly all currencies are priced out to the fourth decimal point. A percentage, otherwise known as a pip, is the smallest increment of trade. 1 pip typically equals 1/100th of 1%. In most cases, retail or beginner traders trade currency in micro lots, because 1 pip in a micro lot is only a 10-cent move in the price. This makes losses easier to cope with if a trade doesn't produce the expected results. In a mini lot, 1 pip equals $1 and that same 1 pip in a standard lot equals $10. Some currencies move as much as 100 pips, or more in a single trading session, making the potential losses to the small investor much more manageable by trading in micro or mini lots. Thank you very much for watching this video. If you have found it informative, then be sure to leave a like and subscribe to the channel for more content coming.